So the Fed and every politician that you see on TV today will tell you that we are not in a recession.
How worried should Americans be that we could be in a recession?
We're not going to be in a recession.
This is not an economy that's in recession.
We're not in a recession or in a pre-recession at this time.
The data over the second quarter is not consistent with an economy in recession.
The evidence is strong. We're not in a recessionary period.
And if things are going so great, though, then why is it the White House officials are trying to redefine recession?
No, we're not redefining recession.
So obviously, as you can see, we must not be in a recession, right? Well, I'd actually call bullshit on that. The fact is that we've actually been in a recession for quite some time. It's just that nobody ever wants to let us know whenever that's going on because nobody rings a bell at the top and nobody rings a bell at the bottom. The fact is that there's not a soul on Capitol Hill that is interested in letting the American people know that we are in a recession or that we are entering into a recession or that things are going to get much worse for us. And rather than helping us to prepare for it, they'd rather just leave us holding the bag. So I'm going to help you not be a bag holder, and we're going to figure out a way to get ahead of this bullshit. We're basically exhibiting every single symptom of a recession long before we've been talking about it for the last 3 months, even though the news, the media, and the White House is not willing to admit it. And what's more, basically everybody on Wall Street, including those of us in the retail investment community, are basically anticipating a market crash. There's a whole bunch of retail investors in the crowd that don't actually understand what a crash means, what a crash looks like, or how to even trade it. So today, we're going to tackle all those questions and make it nice, easy, and digestible for every ape out there. There's a very dramatic and very romanticized idea out there in the community for what a crash actually looks like, and unfortunately, it doesn't quite happen as catastrophically and as suddenly as all that. Mainly what people have been looking for and what people are expecting, especially people that are angry at me because I didn't help them time the perfect bet, is that there's an expectation that all of a sudden the market's going to be down 50%, everybody's going to be washed out of their trades, everything's going to go down to zero, and the shorts are going to run away with all the money that were pulled out of everyone's accounts on margin call. In actuality, it's very different from that. In reality, a market crash looks more like a steady decline of 1% over a lengthy period of time, but that 1% over every single day adds up quite a bit. As an example, what I have here in front of me is actually the 2008 market crash, which was pretty close to catastrophic, but only on a specific set of days. From the actual top of the market crash, the market actually retraced a total of 53%. That's basically giving back half of the value that was on the Dow Jones Industrial Average from October of 2007 all the way till early March of 2009, where we began the recovery period and we started to actually go into the Great Recession. Oddly enough, the recession was announced in January of 2009, and it proceeded all throughout this lengthy period of recovery during which the stock market actually made a long recovery, and eventually it got back up to the previous point where it had topped out at by about February of 2013. It's a long time for a recovery, and it's actually one of the longest periods that we spent in recession. But the thing is that the recession wasn't actually announced until the market had already crashed, and interestingly enough, the stock market that crashed happened after a major housing crisis that actually was ongoing throughout 2007. So people had been hurting for a long period of time before the stock market even began to decline. And it wasn't actually until there was total capitulation in the market from multiple banks going bankrupt simultaneously that we even had this catastrophic fall off a cliff that you see here, where the market gave up 30% of its value in just 2 trading weeks. Another very dramatic and fantastic example of a market crash is actually the dot-com boom. The dot-com bust, which actually began a bubble starting in 1997 when the market began to run after the tech sector started to take off due to multiple software companies and online businesses going into the age of the internet. With new public access to internet and cheaper personal computers, along with companies like Microsoft that went public, there was a surge of interest in the tech sector, and technology was the whole new gold rush of the modern era. This led to a massive bubble that was accumulated over the course of about 3 years, up until 2000 in March, where the market had hit its top. The dot-com bust ran all the way from March of 2000 until the very end of October in 2002. This was a long bear market, one of the longest in our history, that took more than 932 days, or almost 3 years in total, for the entire market to bottom out and finally hit its point of recovery. And this was actually one of the longest recovery periods that we began, at least for the NASDAQ, because the NASDAQ, as you can see, was very tech heavy. It was obviously the most hurt during the dot-com bust. The dot-com bust actually was the most dramatic example of a tech bust, or any bubble bust, which took a full 218 days from August of 2000 until April of 2001 for the market to drop 67% on the NASDAQ. If you look at comparatively to other indices like the Dow Jones, you'll find that the dot-com bust was a lot less catastrophic. Here on the monthly chart, you can see the dot-com bust on the Dow Jones Industrial, which gave up 38% of its gains. The global financial crisis, which gave up 54.5% of its gains. And even the COVID crash. This is actually the style of crash that people were really looking for. This is the dramatic crash that everybody had expected our market crash to look like, what we're going through right now. A massive drop in the value and equity of the entire stock market in just a few brief days. In fact, the Dow Jones Industrial gave up 38% of its value during the COVID crash as a result of the pandemic panic in just 1 month. What I'm actually showing you, and the reason why I picked these 3 specific crashes, is because each one of them is a very different crash. The COVID pandemic was a black swan event that was basically entirely made up out of panic. The COVID pandemic was just a black swan event where we had never seen such a destructive virus since the Spanish flu of 1917, which also resulted in a market downturn, and later on is believed to have an effect on the market 1929 crash that led to the Great Depression. The 2008 financial crisis was a different crash entirely of the housing market, which also happened in 1929. The housing market actually began to crash in 2007 due to subprime lending, or the less than AA rated loans in the housing market starting to go bust as a result of mortgage-backed securities all going worthless simultaneously, while other Wall Streeters were betting against the housing market using a device called credit default swaps. The technicalities aren't really what's important, but what's important to know here is that the 2008 downturn was a result of the massive loss of equity value in the housing market, which affected the banking sector, which affected everything else. The dot-com bust was entirely based out of the tech sector as a result of new tech companies and a huge euphoric boom in a new type of industry that had never before been seen in the stock market, causing equity value to explode to new heights that we had never witnessed before, and everybody believed it was totally different. But it wasn't, just like every other market bubble. And the thing is that what we're going through right now in our current market is a whole other monster until itself, because what we are doing right now is a simultaneous tech bubble, housing bubble, black swan event due to a pandemic, and a new type of tech called crypto, which is muddying up the waters even further. So we're having a combined 4 crashes of 4 major sectors of our economy, which is resulting in a whole, it's a new paradigm of losses that everybody is experiencing right now. And what floors me the most as a trader is that nobody's willing to admit it. First off, let's take a look at the bull case for our current market and what everybody is talking about on Capitol Hill and at the Fed about why we're not in a recession. What you're looking at is the unemployment rate, which is basically the rate of people who are currently looking for work that don't have a job. Right now, we're sitting at about 3.6%, which is moderate. It's actually pretty good. It's one of the lowest unemployments that we've had in quite a long time. Certainly better than the 2007 crash that we had during the subprime crisis, and it's way better than the world after the tech bubble bust, and it's way better than 1987 after we had record inflation during the 70s. So currently, unemployment looks pretty good, and this is what the Fed keeps talking about. Unemployment is great. Unemployment is fantastic. The job market is strong. The labor market is absolutely great. We have a job. We, in fact, have a job shortage. We have too few jobs for people. There's plenty of people that are. In fact, the Fed is saying that we have too many jobs. There's so many more jobs that need to be filled, and we just don't have enough people to fill them because everybody's got a job, and it's such a crock of shit. The thing is that the unemployment rate is a massive lagging indicator, which is only going to tell you what is going on a full quarter ago. And this is not the real indication of what a recession is. What a recession is defined as, at least until the White House decided to change the definition, is that GDP, a recession is defined as 2 quarters consecutively of negative GDP growth. That's gross domestic product. The gross domestic product is basically just the amount of money that the United States' entire citizenship generates and produces in terms of its monetary value. When GDP goes up, that's growth. When GDP goes down, that's negative growth. That's how everybody else likes to say it. To me, that's just loss of GDP. But anyway, we'll just go ahead and play along with them. The point is that negative GDP growth has been below zero for 2 consecutive quarters. Now, according to every other economist journal, including the Oxford and the Webster Dictionary, a recession is 2 consecutive quarters of negative GDP growth. So why is the White House saying that they're not changing the definition and yet somehow this no longer applies? Well, what they will tell you is that it's because our unemployment rate is so low and our job market is just so damn good. However, if you actually go into the news just by typing layoffs into Google, you'll see that there's a massive layoffs in the tech sector, in Amazon, in Google, Walmart, Target, all of the retail sector. Oracle just cut their jobs. Bank of America is laying off. Warner Brothers is doing some layoffs. Robinhood, the Robin the Hood broker that we all know and love, is laying off more than half of its workforce. And basically every major financial firm on Wall Street is throwing people out the door by the hundreds every single day. So how can we say that the unemployment rate is so great? Well, as I mentioned, it's a lagging indicator, and this data is slow. We're not actually going to see the results of all these job losses until, Friday. So currently the Fed is facing down basically the barrel of a gun, for lack of a better term. Right now, the economic data that's about to come out on Friday, first thing in the morning at 8:30 Eastern Time, is going to show that the unemployment rate will be moving up. There is no other way to say this. The unemployment rate is going to be increasing. Why? Because we've been doing layoffs for the last quarter and a half. The layoffs have been substantial. The car repo market is exploding right now. If you check out this article from Barron's titled "Car Repos Are Exploding," that's a bad omen, and I certainly agree with them, you'll notice that the jobless claims are increasing alongside a massive, massive amount of car repossessions. And the thing is that car repossessions are a leading indicator of unemployment. Why is that? Because people need a car to get to work, and if people are losing their jobs, if they can't make enough money in order to pay for the new car that they bought or keep the car that they bought years ago, then how are they going to get to work? How are they going to continue to make ends meet? And this can be both the cause and the result of job loss. It's just a fact that in America, almost every single American needs a car to get to work. And even more so since we have now basically hustling jobs where everybody is either doing Uber, Lyft, DoorDash, Uber Eats, Postmates, and every other type of different delivery service that you can think of. Everybody needs a car. especially people who are in the lower income brackets who are fulfilling these service, courier, and gopher jobs. But it's not just people in the lower income brackets. The guy that was referenced in this article says that he's never seen so many people making more than $2,500 a month owing $1,000 a month in car payments. That's because the cost of all these cars has gone up so high because there was a massive delay in the manufacturing of new cars, which caused used cars to go up in demand, thereby raising the price, which caused people to have to refinance or take out a title loan against their existing car in order to buy another one, or trade in value, so on and so forth. All of these factors play into the fact that everybody is getting a little bit more desperate every day. And it's really no surprise because when you look at the few news articles that will actually print the story, wage growth hasn't kept up with inflation for a very long time. And in fact, wage growth hasn't been able to keep up with just about anything, including inflation, but also the cost of actually owning a home. While the median house prices have been growing at greater than 100% for the last 10 years, the growth rate of wages or median household income has barely even scratched 30%. Everybody is stagnating in terms of their wages while the value of everything continuously skyrockets, and it's gotten entirely out of hand thanks to the inflation rate. And we've talked about this many times before. The Fed keeps looking at the inflation rate saying, yeah, we know it's bad, but we've got it under control. But the reality is that they have no idea how to even begin to deal with it because we've got half of the senators and the representatives out in the West Coast and other states that are looking to give an inflation relief fund, basically printing a check to everybody who is currently dealing with the cost of inflation, where they're going to end up giving that cash to people who don't need it. And that's just going to cause more inflation because when you print more money, that results in inflation. And it's hilarious when you compare the inflation now back to 1970s when it was record high, the high watermark being almost 20% inflation was the highest that we have ever seen. But we've never even dealt with half as much inflation as we as we have in the last 3 decades. This is the worst that it's ever been for anybody who's actually been in power that's experienced it. Basically everybody who's up in Capitol Hill that's ever dealt with this maybe saw inflation this high when they were young. But they were not dealing with the consequences in the same way that they will be now, in that they have a leadership position and it's up to them to make some decisions. And the fact is that they're just not making any decisions, either because they don't understand it or because it isn't in their interest to try to stop it. And what makes matters worse is that they keep sending out this bullshit narrative that the American consumer is so strong. The fact is that the American consumer, as you can see by the use of credit cards and revolving debt plans, is that it's skyrocketing ever since we came out of the COVID relief funding, where everybody has been basically putting all of their necessities onto credit cards, and now they're dealing with the debt. And for whatever reason, you have media like MarketWatch, which is printing a bullshit figure about how much value is in the average American savings account. And they're basing this off of a Northwestern Mutual's 2020 Planning and Progress study showing that the average amount of personal savings in 2022 is $62,000, down from $73,000 in 2021. I don't know anybody in my entire circle that has that much money just chilling in their bank account. It's a complete bullshit narrative. Even if this is truly the average, it's not a reflection of what average Americans are actually holding, because an average figure is pulled up by everybody in the 1% class who has millions of dollars in their savings account. They literally have so much money sitting in their savings account that they are pulling up the entire average of all American citizens across the board, such that it lifts the figure to an absurd five-digit figure like this. I went and I looked, and MarketWatch did actually publish an updated article which shows you a much more accurate picture of what is in American savings account, but even this is probably extremely optimistic. If you look at the average savings of Americans at any age, you see that under $35, Americans have an average of $11,000, and I still think that this is extremely lofty. But the median is what you need to pay attention to, because the median is showing it is a weighted figure that shows you what half of Americans' average is. So the lower half is accounted for and has greater weight, because 50% of Americans, frankly speaking, have far less than $3,000 in their bank account. Some may have $0 in their bank account. And it's only because of the other 50% on the other side above that population threshold that actually have money in their savings account that are in the upper middle and the upper class that are actually able to continuously save their cash. And right now, people that are in the middle class and below are suffering massively. But these are not one and the same article, because here MarketWatch is trying to indicate that the average American has just $62,000 chilling in their bank account, which is not realistic. And here they're separating it by age, which shows one, a much lower figure by average, and it's also showing the actual median. If they actually put these two figures together and show what the median value of Americans' bank accounts were based on today's data, I assure you that this figure would be far, far, far lower. And you can see this reflected in the personal savings rate. The personal savings rate, which you can find on TradingView or basically any of the Fed economic data charts, you'll find out that we actually haven't had this low of a savings rate since the 2009 post subprime crash, where Americans were going homeless across the board. This is the worst that a personal savings rate has been in more than a decade. And if you want to talk about a real kick in the balls, take a look at the United States Consumer Confidence Index, where everybody's saying that the consumer is strong, that the consumer is spending so much money. Spending is up. Spending is great. The amount of money that the American consumer is spending right now is fantastic, and it's keeping the economy strong. But it's all bullshit because, one, they're using their credit cards just to stay alive, and the reason why the spending is so high is because inflation is so high. So every American that's spending anything, they're spending more on food, water, and gas, and they can't actually afford the other things that are necessary in order to give you quality of life. In fact, the Consumer Confidence Index is so low right now, it's at a historic low to the point where it is below the 1980s when it cost so much money and the interest rates to own a home were well over 20%. The narrative that's being spit out by the White House and the Fed is so entirely out of touch with the situation of the average American that it really flies in the face of everything we know about a recession or an economic crash. And despite everything that they will tell you about how strong the economy is, the bond market completely disagrees. This is the 10-year Treasury yield curve, which shows you the 10-year versus the 2-year bonds. The only thing that you really need to know about this, you don't have to understand it, but it's simply the difference between the yields of 10-year Treasury bonds and the 2-year Treasury bonds. Whenever there is an inversion, meaning that 2-year Treasury bonds yields goes above the 10-year Treasury bond, that difference is reflected in a negative number. Right now, we have an inversion that is so deep it takes us back to the dot-com bust era. What this indicates is that we are going into a recession. The 10-year Treasury yield curve has shown us every single recession that we have ever been in, from the 2008 subprime crash to the 2001 dot-com bust, back to 1980s and 1990, and also back in the 70s when inflation was record high. And this isn't even the worst of it, because in fact the 3-month Treasury yield was actually inverting over the 10-year not so long ago. It was within 3 basis points, 0.03% difference from inverting the 3-month Treasury bills over the 10-year bonds, which is insane to think about. So when the Fed tells you that we're not in a recession just because the unemployment looks good and that 2 consecutive quarters of negative GDP growth is totally meaningless and that's not the definition of a recession, you know that they're gaslighting you. So now we get to the juicy bits of how in the hell am I going to save myself from this whole fucking god-awful mess? Well, I'm going to show you a few things that we can do in order to protect ourselves and hedge against this thing that's coming towards us. First of all, I want to go over the basics. The one thing that you need to know is that you do not need to be playing the stock market if you are in a situation where you need to be pinching every penny. If you are in that situation where you're barely getting by paycheck to paycheck, you should not even be thinking about going into the stock market. You should not be thinking about investing in crypto. You shouldn't be thinking about jumping into whatever it is. What you should be doing is saving your money and trying to get ahead of your credit card bills. If you are paying a huge amount of money on revolving credit card debt, what you need to do is do everything you possibly can to get out from under that debt. Find a way to make enough money so that you are getting out from that revolving consumer debt. That is the situation that you're dealing with. That's what's real to you now. That should be your main priority. Because the fact is that your chances of actually outpacing the market, timing it perfectly, and making yourself insanely wealthy is slim to none, especially if you're totally new to it. And if you're dealing with the stress of all of that debt hanging over you, then that stress is going to kill any idea that you have in being able to make the perfect play. You won't be able to do it. I know from experience that that kind of stress just kills your ability to do consistent trading. If that's your situation, then I beg of you to please consider find other ways in order to make money. Get another job if you can. Figure out ways to pinch your pennies, drive less, get a bus pass, subway pass, anything that you can do to save cash, save on gas, do anything you possibly can. And if you're in that situation, I'm probably preaching to the choir and you probably know what you need to be doing. But if you don't, then that should be where you start. Save your money, get out of your credit card debt, and figure out a way to get a little bit of cash saved up and keep building that capital. Because eventually this crash will come to an end. And once that happens, when you have that savings set aside and you have yourself at least a little bit to put into the stock market, there is no better time to buy than during the deepest parts of a recession, because that is the bottom. That is where you can build up your capital and your strength from there. And it is far better to spend more time in the market than it is to try to time the market. For everybody else who is already playing in the stock market, you have a stable income and now you're just trying to learn how to capitalize on the situation right now so that you are making money on the way down, or at least hedging yourself against a crash, then this is what you should be doing. First, I want to preface this by saying that this is not financial advice. I'm not a financial advisor. I'm just an amateur investor, and nothing that I say here should be taken as financial advice. You have to do your own research, your own due diligence, and every financial decision that you make is your own. I cannot be held responsible for your own financial decisions. So please take this with a grain of salt and do your best to do your own research before you make any decisions based on what I'm about to say. Going forward, here we're looking at the SPY. The SPY is the tech sector index based off of the S&P 500 index. The SPY is actually a pretty good barometer of what the stock market is doing because it's got a nice wide range, nice big basket of stocks and different equities that you can trade, and is very easy to trade. What's more is that we're trading in some different technical patterns, and if you're new to technical patterns, then that's okay. The only thing that you should really know is that currently the SPY is in a downtrend at the moment. If you're new to stock trading and you're not familiar with what shorting is, or if you're unable to short, then I wouldn't be considering this right now. I also wouldn't be talking about options, but I am just going to go and briefly go over what the possibilities are so that those of you who are in that position that you're able to take that type of risk, you know what to do and you have some ideas going forward. So, for the time being, what I've drawn here is a big regression channel. That's this channel that's in the blue and red. Right now, this regression channel is showing that we're clearly in a downtrend. And if you look at any of the other major moving averages, which is represented by these lines here, white is the 9-day moving average, light blue is the 20, green is the 50, orange is the 100, red is the 200. What you should know is that if you're trading below the 200, you're in a downtrend. So you should be moving with the trend. The trend is your friend is a common phrase that all retail investors should be more than familiar with. Right now, we're at a position where the SPY is just about to tap on the top of that 200 period moving average. And if you notice, I have these zones marked out on my chart where I show that there is a TOOT, or an institutional selling zone. These are the top areas of the market where the prices have never been better. And right now, institutions, I guarantee you, are thinking about getting out of their bags because right now there's layoffs and a whole lot of economic strife coming their way like a freight train, and they're tied to the tracks. So they're looking to empty their bags, get a little bit of weight off of them, and get out of the market before things get out of hand. Now, there's a couple of other factors that are going on in the market right now. They're trying to make money on the way down and catch those rallies on the way back up. So nothing that we do to plan here can ever be perfect. So what you should be doing is making sure that you're hedging yourself and looking for opportunities on your own. But generally speaking, the trend is likely to continue downward for some time. And right now, we're tapping on a ceiling that is just a basic technical pattern showing that we are probably in for some pain right now. And what's more, everybody who's currently in the market that was down here was thinking, man, we got so much farther to fall. Things suck right now. And then sure enough, the market went in the other direction. Even I was fooled by this. This is what we call a sucker's rally. And right now, the sucker's rally is pulling in plenty of suckers at the moment. What you can actually do is you can draw these trend lines and you'll see very quickly that we have what looks like a big triangle. We call this an ascending wedge. This ascending wedge is actually quite a bearish pattern, and since we're about ready to tap that 200 period moving average, I'm expecting the SPY to take a turn to the downside pretty quickly and in a hurry. So the next step here is that once we see that we have confirmed a breakdown, or when you see a nice big printing red candle taking this price back down to the downside, I'm looking for below 410. That will tell you confirmation. The market is heading back down, and you just simply sell all the way down to the bottom of this regression trend. And this is a very simple tool that you can use just to give yourself a little bit of an advantage over everybody else in the market. Trading based on where price action is more expensive. You sell when it's expensive and you buy when it's cheap. And that's the simple principle here. For me, I'll actually be trading puts. Those are options to bet on the value of the SPY going down for the next several months. As a matter of fact, I think that right now, for about the next 3 months going into October, the SPY is likely to see quite a lot of pain. And I can tell you this just through anecdotal evidence that the market tends to go down in the fall. It's just whatever it is about October and September, that's the month of crashes that just historically have played out in the market over and over again. This is the NASDAQ, which you'll find is actually doing something very similar right now. As a matter of fact, the NASDAQ even looks more bearish because this ascending triangle, or this ascending wedge that you see here, is much taller. It's been ripping up to the upside for quite some time. And the NASDAQ reacts more strongly to tech sector downturns. And right now, the tech sector is doing some massive layoffs right now. We have a big piece of news coming out on Friday called the unemployment rate update and the jobless claims. All of those are going to be updating the unemployment rate, and that's going to kill the last of Jerome Powell's fantasy that we have a strong labor market and that we're not in a recession. He has been leaning on this statement that the job market is so strong that we can't be in a recession. But it's the only piece of data, the only piece of evidence he has left to prop up his argument. Once that argument is proven false, he will have no choice but to admit that we are in a recession. Or if he chooses to deny, he has then evidently gone into the realm of delusion, and the propaganda will continue until it's basically too late and nobody can be saved. So just take what I have to say with a grain of salt. I can always be wrong, but God, just look around you in the streets and you can see that things are not fine. So how can you trade the NASDAQ? It's looking pretty expensive. Well, the first thing that you can do is you can either buy puts on the Qs. The QQQ is the Invesco Trust, which is heavily weighted against the NASDAQ. You'll notice that its chart looks almost identical to what the NASDAQ was doing. You can either buy puts against this, or if that's even too expensive for you, you got another option. You got the SQs, which is a pro ultra short that you can use in order to invert the Qs. This goes opposite to whatever the NASDAQ does. So when the NASDAQ goes up, this goes down. If the NASDAQ goes down, this goes up. And right now the NASDAQ is about to go down. So you can bet that this one, any bullish bet that you make on the SQs is going to respond pretty positively to some pain in the NASDAQ. It's much better to do all of your trading and all of your chart pattern writing on the actual NASDAQ itself, because there's a little bit of drift and a little bit of skew going on in the SQs chart, since it is an inverse leveraged ETF. So it's not going to be perfect, a perfect comparison, but it's pretty close. The point is that the NASDAQ is looking like it's about ready to tap on that 200 period daily moving average, and that's likely going to mean some downside for the NASDAQ going forward into September and October. So I'm looking for the NASDAQ to break down through the bottom of this ascending triangle and head back down to the bottom quick and in a hurry, likely before mid-September. So all you got to do is either sell a short or go and find a call on the SQs or buy some puts on the Qs, and there you go. You have a short bet on the NASDAQ sector. If you want to do the same thing for the SPY and you feel more comfortable trading against the SPY, then you can either buy puts on the SPY or you can do SPXU. SPXU is the ProShares Ultra Short equivalent to the SQs on NASDAQ. SPXU is basically the same thing for the SPY. So whatever SPY does, this does the opposite. If SPY goes down, SPXU goes up. Very simple. And if you notice, if you actually draw this line, it's looking very much like it's preparing for a V-shaped recovery. Or if you looked at the way that the SPY had crashed before, right after the SPY had made this nice big rip to the upside, it very quickly decided to turn around and screw everybody on the way back down over the following 2 months. So if that's what's about to happen right now, guess what? We're heading all the way down, baby. All the way back down. You also have on your side the Dow Jones Industrial Average Index, which you can also bet against. It's doing very much the same stuff. Again, you have this ascending wedge that you can see starting to form right here, and it is about to tap on the top of that 200 period moving average. So you do look like it does look like it is about to break down very soon. All you have to do is see these candles close down below this ascending wedge, and you'll very quickly see the Dow Jones turn around. So these are all the technical patterns of the major indices. If you want to bet against the Dow Jones Industrial Index, which is mainly made up of retail and industrial stocks, then you want to go with SDOW. SDOW is the inverse of the Dow Jones Industrial Average. So whenever the Dow does, SDOW does the opposite. So if Dow's going down, SDOW's going up. And then last but not least, I got my personal favorite, which is XLRE. This is the real estate sector index of the S&P 500. So this is basically like SPY, except for the real estate market. So whatever the real estate, including both residential and commercial, you can bet against XLRE in order to bet on basically a housing crash, which we can basically confirm now. If you want to learn more about housing market stuff, I recommend 2 different channels. One, Reventure Consulting, which is an excellent data-driven channel on YouTube that will describe everything you need to know about current stock market trends, and also Real Estate Mindset, ran by Travis. And both of those individuals will give you an excellent bird's eye view of whatever the housing sector is currently doing, and we are expecting a housing crash very, very shortly. I've not spoken with the gentleman. This is not an endorsement like a paid endorsement or anything. I just watch their stuff, and I happen to agree with their thesis, and I think they've got some pretty good data and a really good idea of what's about to happen. So if you're betting against the housing market, betting against XLRE is a good option. There's also the possibility of going against the housing market by betting for DRV. This is basically SQ, except it's betting against XLRE. So whatever XLRE does, you guessed it, DRV is going to do the opposite. And look at that, it's bouncing off the bottom of this regression trend channel. So you can bet that if the housing market is in for some pain, then DRV is going to have a field day. And we are even right now starting to look like we're about ready to shoot to the upside. If you were to draw a pattern on this, you will quickly identify that we are currently forming a falling wedge, which is just the opposite of a rising wedge. These are actually quite bullish, so if we break out to the upside, that's right, we're going to be heading back up to the top of this regression trend. I do want to spend a little bit of time nice and zoomed in on the NASDAQ right now because I feel like it's a good idea to take a nice close look at the things that are going on, even on the short-term time frames. This is the 15-minute on the NASDAQ, which you'll see is also showing a rising wedge on the shorter 15-minute time frame. Right now, NASDAQ is looking like it's hitting a top, and it's hit some fierce resistance right now. This resistance that it's running into is actually pretty stiff. And if you go back all the way back here, you'll notice that the NASDAQ actually had this big fall down from this area. So there's a lot of selling pressure waiting to push this thing back to the downside if it decides to challenge this price area above 13,400. So this area for the NASDAQ to break out is going to be quite difficult. Before the NASDAQ could even have a chance of breaking out, it would need to hold on to this current level of price action and go sideways for quite some time before it has a chance of moving back to the upside and reaching the next level before it can move along. The more likely scenario and the bearish scenario, which I'm currently toying with, is for it to reach down to the bottom of this trend, consolidate for a short while, and then break down quickly, and then continue on a selling off pattern on the way down into September. Be on the lookout for that economic data for the unemployment rate update and the jobless claims, which is coming out on Thursday, the unemployment rate Friday. Before I go, the last thing that I want to leave you with is just some words of encouragement. Life and what happens to us are entirely out of our control. But what we decide to do with our options and what we decide to do with our time is entirely our decision, and it defines how we react to the situation in which we find ourselves. If you watch this video through to the end, then I appreciate you sticking with me, and I hope that you learned something from this. If you enjoyed the video, please leave a like, consider subscribing, and if you're looking for more content like this, along with additional financial education and a kind community that will help you through your trading journey, I encourage you to look up Hell's Trading Floor at discord.gg/Hell's Trading Floor. That's it for now. I look forward to seeing you first thing in the morning, at which time we will have a hell of a time in the markets.